Hey everyone, welcome back to Drawbridge Finance. My name's Levi Woods and I am not a financial advisor. I am not offering financial advice, but I am a long-time investor and I'm trying to help people make better decisions to make their portfolios grow. Today, Glenn has asked, my question was more general, just wondering if and why you prefer stocks over ETFs. I'm guessing ETFs would be more diverse and hence less risky, but a stock portfolio could be more personalized. There are a few ETFs which pay decent dividends, such as XEI, ZWH, and ZWB. Obviously, these are not paying dividends in the 7 to 9% range as I've seen on your channel and others. Maybe it's just as simple as that. Well, Glenn, it really is as simple as that. If we look at what the dividend payout is, my target for my own personal portfolio is somewhere around 7%. Let's just flip over to a little chart I've created where I'm going to compare my fictional characters, Alice, Bob, and Charlie, and how they would make an investment of $50,000. If we look at Charlie, he decides he's going to buy $50,000 worth of ZWB and it pays out a yield of 4.9%. He's expecting that after 1 year, he will have collected $2,500 in dividends and the end of year value will be around $5,200. Bob, on the other hand, is going to take his $50,000 investment and he's going to invest in a single mutual fund company with the ticker BK.TO. The dividend yield on this one company is quite large, 9.7%. So he's expecting to get a $5,000 return in the first year off dividends alone, giving him an end value of $55,000. Alice is going to take her $50,000 investment and she's going to split it between ZWB and BK.TO. So what she's doing is she's combining these two dividend payouts to get an average payout of 7.345%. Now this is a lot more in line of my kind of target. So her expected dividend yield is $3,800 for the year and her end value is going to be around $53,000. If we look at this situation, Charlie is probably the lowest risk in this scenario because the ZWB ETF is quite diversified. So without purchasing anything else, he has diversification off a number of companies. Bob, on the other hand, is not diversified enough. He's getting this huge yield, which is fantastic, but for my personal portfolios, I would never put the entire holdings into a single dividend-paying stock. Although the yield is fantastic, 9.7%, it's just not diversified at all, and if that stock price goes down, I'm losing a lot of my principal, so it doesn't matter what my dividend yield is. I have to diversify in order to maintain a predictable dividend income. So Alice also is not really diversified, but I wanted to just give you an example of how we could achieve a 7% dividend yield. So the $25,000 she has invested in the ZWB ETF is diversified quite a lot. The $25,000 in BK.TO is not diversified, which means 50% of her portfolio is in a single holding, and that is not a good way to diversify. I've made other videos on diversification, and you guys should check those out if you haven't already, but diversification is imperative to reduce your risk. But Alice is achieving a reasonable dividend yield in my mind, and Charlie just isn't making that yield, 4.9%. If we skip forward, say 5 years down the road, you can see that Charlie's investment of $50,000 has turned into $64,000, and it's just not enough to continue to grow in a way that you will have enough money to retire. What you want to be doing is aiming for around this 7% return so you can retire early. So the end of year value for Alice is much more reasonable at $72,000, even though she's incurring quite a lot more risk than Charlie. She's certainly taking in a lot less risk than Bob, and you know, if Bob guessed right, if this BK did really well, he would be laughing. But if he had guessed wrong and the value of BK had dropped, he would not be very happy with that situation. In my mind, looking at an ETF for my portfolio that pays a 5% return is great if I can also combo that up with a higher yielding stock. Diversification is key, but again, always looking for the target value of around 7% return in dividends annually. Hope you guys enjoyed this video. Please give me a huge thumbs up if you liked it. Leave your comments and questions down below. Let's get rich together.